All right, welcome everyone to the second session of the day. My name is Siamak Malemi, and I am going to be moderating this panel, which is a decentralized finance practitioners panel. So I just wanted to say a couple words before we get started to sort of set the scene before we launch into discussion. We organized this panel because certainly in my mind, DeFi is one of the most exciting areas within the blockchain space. I think that's for two reasons. First of all, I think it's sort of the first area where we've seen sort of true product market fit in blockchain technology, and I think that's evidenced by simply looking at the data. If you look at let's say the Ethereum blockchain, what are the actual applications that are used in terms of, like, let's say gas consumption? Well, it's decentralized exchanges, it's collateralized lending, it's stable coins. Those are all three, certainly financial functions. Maybe fourth is NFTs, which arguably have some financial component as well. But the reality is the main application of blockchain technology right now is finance. So certainly that's one reason that motivates this panel. The second reason is that many of us are certainly have backgrounds in finance and are quite interested in that. So it's also quite natural to consider these topics. My goal here today is to sort of get the industry perspective. I think this is super important as an academic to sort of be in touch with what is going on in the practical world. And I think that's especially the case in blockchain because the technology is moving so fast. There's oftentimes a disconnect between sort of the relevant problems in the real world and the types of issues we consider. I'll just relate a personal anecdote that I think illustrates this, and really also kind of illustrates another aspect of blockchain, which I think is amazing, which is the rate at which people experiment and try things and learn. And that anecdote relates to a topic I'm quite interested in, which is AMMs and Uniswap. Probably most of you are familiar with these types of decentralized exchange protocols. They really took off in the summer of 2022, so-called a DeFi summer. And as an academic who in the past has worked on problems in prediction markets and market scoring rules, and some of these ideas that predate but nevertheless have influenced these types of exchange designs. I would have, had you told me about this prior to summer of 2022, I would have told you this idea is stupid, right? It makes no sense. Nobody's going to do this. Why not just have a limit order book like everybody else? And so forth. And you know what? I was wrong, right? And I think the evidence of that is, today Uniswap trades more than Coinbase, I'm told. So, again, I think that speaks to the importance of interacting with practitioners. Now, that doesn't mean that we don't have a role. I think, just linking back to the topic of AMMs, I think, once we've discovered that, in some sense the idea works, academics have a big role in understanding them and understanding their economics and informing their design, including many of the people who are here today. So I'm quite excited to get the industry perspective. The way we're going to work this is we're going to start out. I'm going to introduce each of the speakers one by one, and they're each going to give a little bit of an opening statement talking about what they do and the sort of the challenges they perceive in the DeFi world. And I will start the discussion with some questions after that. But really, this morning, I've really been impressed with the level of audience participation and engagement. So I think in the spirit of the conference, we're quickly going to decentralize it. And I'm going to ask you guys to sort of think of the really hard questions for our audience, for our panelists, excuse me, also, so they don't get angry at me. With that note, let's go ahead and get started. I'm going to start all the way on my right, your left, with Nathan Allman. Nathan is a founder and CEO at Ondo Finance. Prior to that, he worked at Goldman Sachs on the digital assets team, helping shape their crypto and blockchain strategy. He has a background in private credit investing at Prospect Capital Management, and he has his bachelor's degree from Brown University. Nathan, please.
Thank you so much. Thanks for having me. It's great to chat with everyone about DeFi. So I guess just to kind of reiterate a bit, my background into the space and, evolution, of my time in DeFi, I got into crypto really in earnest in early 2017 in, the ICO mania when everything was an idea, but nothing was really functional yet. Invested and traded a lot in the space, deep in kind of the last bear market, joined Goldman on the digital assets team. And, we looked a lot at these more kind of enterprise use cases for blockchain and like clearing and settlement of, traditional regulated securities. Most of it was on, private permission chains. We did some one-offs on public chains, like we helped the European Investment Bank issue a bond on public Ethereum that was paid for with a central bank digital currency on public Ethereum, and had plans to kind of use that as collateral in on-chain repo markets down the road, but it was still a bit of a proof of concept. And then really starting in 2020 with the kind of explosion of DeFi summer, as you mentioned, Compound enabling this kind of frictionless leverage on Bitcoin and ETH, and Uniswap being this non-custodial exchange that solved this trust issue of people having to give their assets to all these centralized exchanges in the space. I got really excited about what was happening there, and so we started out actually building structured products on top of like these DeFi native sources of yield. I thought it was a really interesting proof of concept of how we can, build and manage more complex financial instruments in a way that, is still not reliant on any sort of intermediary. But, what we were doing and kind of the whole DeFi space at the time was very reflexive. I mean, it was very fueled by speculation. Like all of the yields were ultimately coming from, demand to lever up things like Bitcoin and ETH, kind of the casino of, all of these, meme coins or, governance tokens on the infrastructure itself, or, liquidity mining rewards. And so, ultimately it wasn't super sustainable. And, the yields in the space collapsed and we kind of went into this, pretty extreme DeFi bear market. And, it left everyone wondering kind of what was next in the space. And, at the same time, we had rates in the real world starting to increase. And, I saw this opportunity to tokenize assets like treasuries and money market funds and bonds, which, suddenly became pretty attractive to the audience of crypto wealth, really of stablecoin holders pretty broadly. And I think now is a really exciting time in DeFi because we can use the same infrastructure, the same on-chain trading, things like, Uniswap, on-chain lending, things like Compound, but we can use them for assets that have an impact in the real world. So on things like treasuries. So as kind of an example of that, we built something that we analogize to a treasuries repo marketplace. We call it Flux Finance, and it allows for lending and borrowing of stablecoins, things like USDC, 24/7, over collateralized by treasuries. And, it's run autonomously. There's no intermediary hosting it. It's global, it's composable with other on-chain financial activities. And so I think it's a really cool demonstration of how DeFi starts to become, just another means of, operating traditional financial activities and, really blurs the line to traditional finance. So, excited to kind of continue building in this space of, regulated DeFi meets securities.
Thank you, Nathan. Our next panelist, immediately to Nathan's left, is Matt Cushman. Matt is a co-founder and strategist at Anja Labs. Prior to that, he founded and was the CEO of Etal Incorporated, which is a cryptocurrency trading platform that was acquired by NYDIG, where he was subsequently the head of electronic trading. Prior to that, actually, Matt has an extensive background in quantitative trading, electronic trading, and market making. That's actually where we originally met. He worked as a portfolio manager and partner at Engineers Gate, which is a quantitative trading hedge fund. He was a senior managing director at Citadel Securities. He was managing director and head of quantitative strategies at Knight Capital Group. Matt has a PhD in mathematics from the University of Chicago. And in addition to the rest of his impressive background, he also serves as the president of the Village Garage Distillery, a craft spirits brand based in his hometown of Bennington, Vermont.
Thank you, CMAC, and thank you to CMAC and the rest of the organizers for putting together a great conference. It's great to get to see all the innovation that people are thinking about on the academic side, and hopefully pose a few questions that academics can help people in practice answer. So, as CMAC mentioned, I'm one of the co-founders. There are 9 of us at Ajna Labs. Ajna Labs, by the way, one of my other co-founders, Ian, I see, is here today. Ajna Labs is developing a series of smart contracts that enables the Ajna protocol. So what is the Ajna protocol? It is a decentralized, collateralized lending protocol on the Ethereum blockchain or any EVM compliant blockchain. And what's different about it? There's a number of other lending protocols, of course, in the space. We've heard about Maker, heard about Aave, Compound, several others, of course, that are active in the space. I think that really, if I had to summarize the unique features of Ajna into one word or into a short phrase, we take decentralization extremely seriously. So what does that mean? There actually are no oracles for Ajna. So all of the price discovery, all of the price activity is endogenous within Ajna. Lenders choose at what exchange rate they would be willing to lend out whatever what we call quote token, that's the currency that would be borrowed or lent within the protocol, at what exchange rate they would be willing to have that with respect to how much collateral is being offered by a loan. So that's one feature. There is no governance. So all of the parameters that govern how the actual lending operates within an Ajna contract are set upon full deployment. And anything that changes, for instance, interest rates or collateralization ratios, et cetera, are discovered through the market activity of the lenders and borrowers that are active in that particular pool. It's not upgradable. So once we give the analogy, it's a little bit like a lunar launch. We have to get everything right upon deployment of the pool. We have no ability to. There's no governance capability. There's no upgradability. There's no ability to censor the contract. Once it's deployed, it's deployed. That offers a great deal of assurance to the users that there's no attack vector via any sort of governance capability, and that the behavior will be extremely predictable. And finally, I think there's a lot of innovation in terms of what we've done around liquidations, right? Without oracles, the first question that people usually ask us is, well, how do you liquidate a loan? The answer is that we have a new capability for a loan kicker, so someone to initiate an auction of an apparently under-collateralized loan, where they will post what we call a liquidation bond, which is essentially put up some capital up front to fund the liquidation. And if the liquidation post hoc, after the liquidation has occurred, you can see the prices at which the collateral was traded in the marketplace. If those look like it was a reasonable liquidation, they'll actually get a return on that capital they posted. However, if the collateral gets an extremely high price, they'll actually forfeit part of the bond. So those are a few of the innovations about Ajna. So what are some interesting questions? I think there's a lot of interesting questions that academics can help us address that come up in our design. Some things are just around efficient algorithms for the blockchain. We are the first, I think, to implement a particular data structure which enables holding an order book and doing various computations on it on the blockchain. It's a derivation of something that's called a Fenwick tree from computer science. There's a lot of room to really push the envelope in terms of more sophisticated algorithms on the chain. How do we rely on the market behavior to determine interest rates, collateralization ratios, prices, et cetera. So we heard a lot about DAOs and various kinds of decentralized activity earlier today. I think there's a lot of opportunity to research there. How to size and manage liquidation bonds. How can you manage an auction in a decentralized manner? A lot of interesting questions around that. And finally, testing and quality assurance. It's maybe sounds like a boring topic sometimes, although I think there's a lot of really interesting things to be done on testing of smart contracts. Smart contracts are two things, right? They're code and they're a computer program. So computer scientists have thought a lot about how to test computer programs correctly, but they're also a contract. And usually quality assurance of contracts is done by hiring a bunch of extremely highly compensated and very smart lawyers to pore over the contract in detail. For us, we're able to actually run it in simulation, which we do extensively with thousands of interactions with different market participants and see what happens. So we think that that's an interesting avenue to explore as well. Finally, I just wanted to say I really enjoyed the last speaker, Prasad's talk, and contrary to his experience with some of his fellow panelists, I do just want to assure everyone today that I'm not the real Satoshi Nakamoto.
Thank you, Matt. Our next panelist is Gordon Liao. Gordon is the chief economist at Circle, where he is responsible for shaping the economic agenda for the firm. Prior to joining Circle, he was at the Federal Reserve Board of Governors as an economist. In addition, his experience spans being a fixed income portfolio manager at the Harvard Management Company to leading research at Uniswap Labs, and his academic work has been published in journals such as the Review of Financial Studies and the Journal of Financial Economics.
Thank you so much, CMAC and the organizers for putting together this great conference and this panel. Since the panel is on decentralized finance, I thought I'd share some views and perspective from my both current work and previous work. Now, I think the term decentralized finance sometimes is used to describe as a crypto alternative to traditional financial system. And it is used a bit in an amorphous sense. Better definition of it, and today I'll challenge the definition to be more encapsulating, I think is needed to move this whole field forward. What I see as decentralized finance is nothing more than decentralization of balance sheet risk. That is contrary to intermediary-based asset pricing that some financial theories study. It is really about moving intermediation capacity and decentralization of balance sheet risk to more actors, perhaps through the use of technology. So I'll make a couple of points. First is decentralization in finance is nothing new. It has been a long trend of decentralization in the sense that there's more market-based activities today than a couple of decades ago. So a couple of examples of this is, if you think about banking, banking started out being a very relational, focused lending type of business. In the movies of It's a Wonderful Life, the banker knows everyone. But today's banking resembles market risk-based sharing. So syndicated loans, MBS securities, most of the banks hold a lot of these tradable securities rather than portfolio loans. In shadow banking as well, we have moved from bilateral repo to tri-party repo to now sponsored or cleared repo. Similarly, in trading, there's been a trend of more movement of balance sheet risk from principal-based market makers to agent-based trading to then exchanges. So the first point I am making is just decentralization is inevitable part of finance evolution. The second point I make is, so what's new about our discussion of decentralized finance today is the technology. It's the blockchain technology, which I think does add in some new elements. And the new elements is, I would characterize it more as more efficient and faster and broader reach in decentralization rather than a whole step function of moving from centralized to decentralized. So as you already know that this network structure of using blockchain allows anyone to access financial services. And that sort of access is way beyond building out a network that you could build in with a set of intermediaries. of course, I think it also comes with a certain amount of risk that needs to be considered, as well as cautionary tales with any sort of network formation, that if the early adopters end up having equitable shares of whatever form of gain, you actually eventually end up stalling the process of decentralization. So perhaps this is related to token distribution or how concentrated it might be. But I think that is something worth considering, as this field develops, is how can you actually have more people bow down and share the incentives to build out a network. And the third point that I'll discuss is, oftentimes in the discussion of crypto and DeFi, there's an emphasis on, especially on the regulatory side, of the various type of risk and spillovers, as Rod earlier mentioned. I think it is important to study these financial stability risks, but at the same time to recognize the various potential benefits from decentralization. And decentralization not meaning the fully permissionless decentralization of everyone being able to do everything, but decentralization meaning a reduction of balance sheet consideration of risk. So today we live in a world where 4 banks failed in the course of 2 months. You have more consolidation in financial activities. And this is a broader trend as well, that in the post-2008 environment, what we have seen is larger footprints of commercial banks with growing balance sheets that also ended up having more regulatory scrutiny, which leads to market distortions. And as a result of this, I've seen at the Fed, one of the ways to respond to this is to provide more liquidity to have a larger footprint of central bank balance sheet. So as I mentioned, this is somewhat of a self-reinforcing equilibrium. To me, this is a very unhealthy equilibrium of having larger footprint of commercial banks and central banks and more regulatory scrutiny at the same time, in which no one's really getting what they want. The way of reversing this trend towards concentration risk in financial system as well as in central banking is to start decentralizing the system. First by probably payments is the area that I currently work in, but I think payments is actually a very critical area, because as we've seen, our banking system is tying payments together with lending, and that results in inherent risk, because the payment flows gets churned really quickly. As a result, you can't necessarily use the deposits for lending, so it ends up being security holdings, which has interest rate exposures. So one way of decentralization is splitting out payment functions and lending functions, which is actually not a new concept. It's a concept that goes back to the 1930s with the Chicago Plan, and that has been discussed in various times. Now, what I think is really interesting at this point is to examine that older concept of splitting out payment functions and credit intermediate functions, but adding in this new layer of using blockchain and using programmable money for building risk-sharing mechanism that's market-based. Because it's hard to generate the same type of credit without also having a market-based mechanism. And today, what we have is a flourishing ecosystem in which it is building these market-based mechanisms through smart contracts that open up capital formation for perhaps asset classes that were previously too small to trade. And I think that has to go alongside with decentralization in terms of splitting out payment functions and lending functions, which is this, then you had to have the market-based credit and risk-sharing functions as well. I'll end there and happy to take questions later.
Thank you, Gordon. Finally, our last panelist is Asim Sood. Asim is a product lead at Uniswap Labs. He helped build and launch the Uniswap v3 protocol, which provided a massive improvement in capital efficiency through its concentrated liquidity feature. Prior to that, he co-founded Open Collective, a startup that provides bank accounts, expense management, and fundraising for grassroots community groups like open source projects. And prior to that, he spent about a decade in Silicon Valley as a product manager at Dropbox and Google.
Thanks for having me. I'm excited to be here. I feel like I'm using parts of my brain that I often don't get to when I'm building these products. So as you probably heard, I have no finance background. And so I thought it might be interesting to just kind of share how I ended up building Uniswap v3, a pretty complicated DEX. I am an engineer by training. I get excited about technology all the time. The question I ask myself is, what makes a technology impactful? And the thesis, I would say, is it takes a pre-existing human behavior and kind of unleashes it in a permissionless manner. So take internet, for example. Pre-internet, you have a bunch of media companies. You have telecom companies. Post-internet, you have Twitter, Facebook. And in the process, so what the internet did is we have this pre-existing behavior to want to communicate, to share. And it kind of amplified this million, billion, many, many orders of magnitude. And so when I think about crypto, or really any technology, I'm like, what is the pre-existing behavior that this will amplify? And so I got into crypto in 2012, read the Bitcoin white paper like many people, got excited about it, but didn't know what to do with it. Went out and did some stuff outside of crypto, came back in 2016, read the Ethereum white paper, and this time I was like, oh, well, we can build stuff. But it was still really hard to kind of express to people what is this going to be doing? And so it took me a few years, and sometime in early 2020, where I sort of realized that maybe the behavior that the blockchain is suited for is trading. And just like our need to communicate, trading is also something that has existed for a long, long time. It's existed for thousands of years. We've exchanged. And when I say trading, I don't mean like necessarily stock trading. I mean any sort of exchange in an economy. Right? It's existed for thousands of years. We've been bartering, been finding new and kind of more efficient ways of trading. And so in early 2020, I sort of came to the conclusion that this is the pre-existing behavior the blockchain can amplify. And if I'm right, then in 10, 15 years, we should see million, billion X more trading happening overall in the system. So this is how I ended up at Uniswap. I went to Hayden and I said, hey, this is my worldview. I would like to help you build the next version of the DEX. And so coming from this kind of technology curve, the next thing if you think about technology curve, the next thing that happens is at first it amplifies an existing behavior. But then after that, the tools enable new behavior. And I feel like now we're at a point where, it's not quite like New York Times putting the print edition online. We're not quite there yet. I feel like we're a little step ahead of that. But we're not anywhere close to Twitter or Facebook or the truly decentralized version of this. And so that's been my interest, that I'm interested to see what can we change as the basic assumptions. So as an example, take ERC20s. ERC20s as like a workhorse of DeFi still represents assets basically the same way you do outside. But that maybe blockchain can offer us more. So here's a thought experiment. What would happen if you turned ERC20s into streaming tokens? We are in the real world, we prepay and postpay everything. I prepay my rent, I get postpaid salary. But if you imagine instead of these assets transferring in a moment, what if it's a flow? So I get my salary streamed to me per second. I redirect some portion of it to my landlord, some to my utilities, some to a dollar cost averaging account. Right? That's my savings account. And so what does that mean? Like, what does a DEX look like on top of it? What does a marketplace look like on top of that? Right? Like, that's the stage it feels like to me we're in. And so I'm really excited to talk about those type of things. And the second thing I'll throw out is, again, in this like sort of permissionless, how do we enable a lot of people, particularly interested in local currencies? I feel like throughout the history, we have tried them in many times. And I'm curious if this is the moment where we can enable them for small communities. How do you like govern them? Do you need a Fed for each one? Like, how would that work? So I'll leave it at that.
Thank you, Asim. So let me just start with a question for the whole panel or anyone who wants to answer. We've heard a lot this morning about DAOs and decentralized governments, and my sense is it actually seems to play a large role in terms of DeFi. It seems like most DeFi protocols, certainly Uniswap, Compound, and so on, they have some sort of decentralized governance feature, maybe not Ajna. I learned this morning that most DAOs actually are governing DeFi protocols, so we have the opposite relationship. But nevertheless, it also seems like there's maybe a bunch of issues here. There's low turnout and participation in these government mechanisms. Strangely, a lot of these mechanisms, a lot of the significant economic participants seem to outsource their decisions to college blockchain clubs, which maybe is okay in some sense, but in another sense, it seems a little odd. It's typically, I think, slower and more friction than standard sort of corporate decision making. You have politics, maybe in sort of the worst sense of the word. So for the panel, what's the role of decentralized governance in DeFi, and is it an effective mechanism for managing DeFi protocols?
Well, I'll take it now. Our philosophy at Ajna, and it's not to say that it's the only way of approaching the problem, was to really try to take governance out of the protocol aspect. I mentioned that before. So once Ajna is deployed, there is no DAO, nor do any of the founders or co-founders have any capability around changing the actual behavior of the protocol itself. We do think that it's important to foster a community of activity around, there's going to be a need for sustained activity to support the development of a community around any protocol, and in particular Ajna. For example, providing a convenient front end for people to interact with the contract. So there is one of the aspects of DAOs that were discussed this morning is a DAO is a sort of VC fund, right? And so there's a sort of, I guess you could think of it as analogous to a VC fund to fund projects that would support the community around Ajna. And that fund is directed in part, or well, entirely by voting of Ajna token holders, effectively acting as a DAO, to provide some Ajna funding for people to develop front ends. So the idea there is that Ajna token holders would be incentivized or aligned in doing things to support the community in that regard. Although there's no ability, I think one of the problems is conflicting incentives between people that may own the governance token of a particular protocol, but have other external incentives as well to interfere with the proper function of the protocol. So that was something that we chose to try to really avoid in designing our protocol.
I think that was certainly an issue that was brought up this morning. Do you have any thoughts on, I know DAO has a big role in Uniswap. Do you have any thoughts on?
Yeah, so when we thought about DAO, our kind of the evaluated function was we want to minimize the governance decisions. And I think you could kind of contrast Uniswap with Compound. At some point, when I talked to Robert Leshner, he was saying that about every 2 weeks, there's a decision that Compound governance makes. And I don't know what the right kind of cadence is, but there was definitely something about Compound governance that feels like it's more, the activity makes people participate. The flip side I would say is, as like a user of a lot of these protocols, I think I suffer from the decision fatigue. That it's not clear to me that as much as like there's a should associated with it, like, yeah, you should pay attention, but it's almost impossible. And so in that world, maybe the college blockchain groups are not the right choice, but there's definitely room for some sort of representative I could trust along the way.
Thank you. Question for Gordon. Stable coins as a product have been sort of a huge success. USDC, among others, has seen tremendous adoption. One sort of a big feature, though, is that they don't pay interest, right? So when Fed funds rates at 25 basis points, that's not a big deal. When it's 5%, maybe it's a bigger deal. So my question to you is, do you view this as an obstacle to the adoption of stable coins? Are there obstacles to actually paying interest? So, for example, are there regulatory or technological reasons? And how do you see this playing out going forward?
Yeah, I don't think that is an obstacle. In economics, there's a term called convenience yield. That is, you hold, even though they might not have interest directly paying, but there's a yield accrued to you in terms of convenience. So today, there is $2.3 trillion of US dollar in circulation in physical bills. 1.8 trillion is $100 bills that's in circulation. And that's despite the fact that payment has become more digitized. the growth in physical circulation of currency has actually increased. In the US, it's about over 100 billion a year. In other countries, including the Eurozone, it's also growing at a similar pace relative to GDP. So I think the demand for cash-like instruments is not going to end, but it might be taking a different form. So I really see, regulated, potentially well-regulated payment stablecoins that's fully backed and fully reserved as a form of cash plus that is digitized, as tokenized cash. Given that people are willing to hold cash without interest rate, we can observe that people have also been willing to hold non-interest-bearing instruments such as digital cash. Of course, there's a regulatory consideration as well because currently USDC just simply cannot pay interest.
Because of securities laws.
Well, I'm not going to say it outright, but I think there is also just compelling use case, even if it doesn't pay interest, and it still facilitates a store of value.
Thank you. Question for Nathan. I think you're a little bit unique in this panel in that you're focusing on integrating crypto with the traditional financial system, namely the treasury market. I think remarkably, this is something there's been very little of. Largely, they seem separated. I mean, obviously, one possible reason for that is regulatory. I'm curious your thoughts about that. I'm also curious how you see traditional financial institutions adapting to DeFi and whether we can see those types of collaborations or partnerships increasing in the future.
Yeah, definitely. I mean, I think the opportunity for tokenizing cash equivalent securities like short-term treasuries and money market funds, which we're working on, has really only presented itself relatively recently. I mean, stablecoins had, product market fit for quite a while in, an environment with near 0% interest rates. So, we started working on this in early 2022, and certainly it took a long time on the, legal and regulatory analysis and structuring to bring this to market. I agree with pretty much everything Gordon says, for the record, about the market and utility for digital cash, and certainly the float of physical cash being some evidence of that. But I think there is also a market for taking these cash equivalent securities and making them more easily transferable globally 24/7 and usable in on-chain financial infrastructure. The lending marketplace that I mentioned being a great example of that, and obviously one that parallels very massive traditional markets in the form of treasury and repo markets. And so I think it's very, very early days in that space, and there's certainly trade-offs in terms of accessibility. I mean, everyone in our products has to be an accredited investor. We're selling these securities under the Reg D exemption. But I think very slowly we're sort of chipping away at that divide between on-chain and traditional securities markets.
Do you think there will be demand from traditional market participants, institutional investors, perhaps for 24/7 type of trading reasons or other types of reasons?
I mean, not in the first couple of years. Like, I think certainly the beachhead is the existing on-chain economy and crypto wealth, and bringing these more traditional assets to them in a form where they can on and off ramp from stablecoins more easily and convert to other crypto assets. But I think that there are longer term opportunities to provide versions of very traditional financial services that are cheaper and more efficient, and maybe there's some benefits from 24/7 as well, though I think a bit less of a focus on that. But I think that we have to build out the marketplace first in this sort of new economy and, show the utility before we can really get institutions on board. I mean, I think institutions will come on board as issuers and as asset managers, much sooner than they will as investors. Because, there are fees that we layer onto these products, and you have to be able to use the on-chain financial systems that leverage these tokens in order to want to pay those additional fees.
Got it. Thank you. So let me open it up to questions from the audience. Yes, Thomas.
So I have a question from a finance standpoint, in particular about the long-term sustainability of financing DeFi innovations. So one concern would be that, like with Uniswap V3, it seems like your ability to basically monetize this and pay for future developments rests on having some intellectual property laws being, adequately applied in the jurisdictions that you're operating in. Have you ever thought about some of the challenges you might face in the future, ways to get away from relying on IP to be able to be sure that your innovations, that the developers of those innovations can be adequately compensated so we can maintain the right incentives for these innovations in the future?
Yeah, so we started a foundation. So Uniswap is sort of interesting, right? So just for people context, so there is the Uniswap, the company, labs that I work for. And then there is the DAO, which is managed by the Uni token. And then there is a foundation, and the DAO has, some, let's say, $1-2 billion in Uni token as their assets. The foundation has maybe, 30 million or something like that they got as a one-time funding from the DAO with an on-chain vote, right? So that's sort of the three players in the space. And the hope would be that over time, the foundation sort of becomes the owner of the protocol. And so with Uniswap V3, we had a BUSL license for 2 years, which is a business use license that said that you can't copy it for 2 years except via governance's permission. So if you want to deploy it on a new chain, you need to go through a governance vote, right? That 2 years has ended. And now, sort of funding like the next version of the protocol, you could see how the foundation and DAO could continue funding it, right? And like whether they decide to continue with the BUSL license or a different kind of license, it's sort of in that public domain. And that's how, like, our view is that that's how it should be done.
There might be some concern that, basically people can undercut any sort of money that's being channeled towards development. You can say, we'll channel less money. After you develop it, I just copy it, and I lower the fees that the organization takes.
Yep. Yeah, I mean, I think practically speaking, so let's say, let's pretend that you were developing this outside. Even if it was open source, the fact that it needs to be audited, it does matter that it's under the Uniswap brand, right? So like those are things that along the way, it's not like I could take the code and publish it and say, hey, it's working, people are just not going to trust it, right? And then presumably with the DAO, the people who hold the Uni token, right, they have incentive again to support the protocol.
Yes.
Within this system of governance structure, one, when you talk about governance, is it based on real human nature? Because there's a lot of work on the rationality and complete contracts. Oliver Hart has written a lot of that. And number two, what is the role of government in terms of governing this? Because the government has a role to play in governance in terms of creating efficiency in markets or positive externalities. That's the whole purpose of government, at least in theory. So where does the government fit in?
Okay. So I think, again, like going back to the first question around kind of government minimization, right? So when you're developing a protocol, the question you ask is what levers do I want to expose? What are the decisions that I'm comfortable making as a protocol developer, and what are the decisions that I think can be tweaked over time? And so in case of Uniswap protocol, there's actually very few. So the Uniswap governance can turn on fees per pool. They can add a new fee switch, which was done at some point. And I think that might be it. It might be one of their minor things. But that's it. Like, so in a way, when you're developing the protocol, you're sort of defining what governance it means. Now take like Compound, for example. Compound constantly tweaks the loan ratios or the collateral ratios that are required, right? So that's like a constant thing that'll happen. That's why every 2 weeks there's a new vote. Something has changed. And that's a decision Compound made. In order to be sort of active in the market and be connected to it, they have to tweak that, and there's no other way to do it.
I'll add in, since you brought up Oliver Hart, so I'll add in some thoughts on the theory of the firm. The boundary of firms, as at least in the incomplete contracting type of framework, is just limited by information asymmetries by firms, right? What governance in DAOs and in DeFi more generally does, I think it eliminates certain amount of information frictions that in theory should make governance easier. And I don't think it's, again, like that different than how governance work for corporates, but it is different in that you have less informational frictions, you have more symmetry than, from at least a theory of the firm perspective, you should be able to broaden what the boundary of the firm is, and that you should solve some of the classic issues with principal agent problems and that sort of issues, just to relate to perhaps what you're thinking.
Well, can I just, I wanted to add one thing. CMAC, first of all, I wanted to say that I think Uniswap's done a great job in terms of eliminating as much as possible the opportunity for the governance token to have a undue influence on how the protocol operates, and we look to that for inspiration behind some of the design of Ajna. So I think kudos to Uniswap for paying attention to those issues. And finally, governance versus government. One thing I think it sometimes gets lost in all the rhetoric around DeFi and crypto in general is that at the end of the day, it's subject to all the same laws that anything else that's a human activity would be subject to. If you trade physical gold, obviously gold has a certain physical reality that is not going to bow to the law of Congress. Having said that, whatever laws and regulations and how they're interpreted by the courts, we're still all bound by. So there's really nothing that is going to circumvent any particular legal aspect of a jurisdiction just because there is or isn't particular governance capability built into the contract. But it does, it provides both an opportunity but also a danger to have governance capabilities as part of the contract to provide another vector for people to attack the integrity of the protocol.
Yeah, question.
I think this could be for anyone, but probably mostly for Nathan. In thinking about the integration of traditional and DeFi, I envision this dialogue with the regulator, say the SEC or Treasury, and the DeFi position is a market is essentially a contract, a set of rules, and that's what we're contributing. And then the regulator says, yeah, well, who will implement these rules? And the DeFi response is, it can be implemented anywhere. But the SEC, to take an example, has a very definite rule, so system compliance and integrity, and traditionally they have viewed the hardware and the software, so to speak, as bundled. And the response that it can run anywhere is not quite the same as it will run anywhere. This may be a softball question, but.
No, I mean, it's a great question. From the perspective of Ondo, we're really focused predominantly on the issuance of these securities. And that's actually relatively straightforward how to comply from a regulatory perspective. I mean, the funds use very, well understood exemptions from registration, 3C7 specifically, and we're selling these again, under Reg D. And so, if anything, the use of smart contracts makes it even easier to comply with certainty around things like, maximum number of investors for, private exempt securities. What you're bringing up, I think, sort of gets into the trickier questions, what is a decentralized exchange in the context of, the 34 Act, let's say. And, we're not grappling with those as much from the perspective of Ondo. I think they're
They
very
speculate.
tricky questions as to, who would, comply with some of these, requirements imposed on, intermediaries post-issuance. And, I don't want to speculate too much on that. I don't know. But, I mean, the sort of natural point to regulate would be, centralized businesses that offer access to these sorts of protocols, but sort of an open question around, what are these front ends? Are they, fancy block explorers or, regulated financial service? So we'll see.
Yeah.
I have a question for Anja. How do you determine the funding rates for your lending markets?
The funding rates meaning the interest rates or the collateralization? So they're essentially, they start out at a certain level, depends on whoever launches that particular pool, and they adjust as a function of the average utilization rate of the pool. So it's relative to the target utilization. So it looks at how, essentially on average, how over-collateralized the loans are versus how much of the quote token that's been contributed to the pool is actually being used. And if there's a lot of excess quote token, right, that kind of suggests that there's an excess of lenders and not enough borrowers, and it will start to lower the rates. If there is a shortage of quote token and the loans seem extremely over-collateralized, it suggests that people will be more willing to borrow more, the rates will go up to attract more lenders.
So this is similar to the design of other lending protocols in that respect, right?
Yeah, there's a certain similarity. I think at least some of the other lending protocols, the whole curve as a whole can be moved via governance. So we've eliminated that part. And
Now it's just a fixed. Now, don't you run into an issue though where the rates just aren't really good if the pool doesn't have high utilization?
Yeah, so if the rates aren't good if the pool has high utilization.
If it has low utilization.
Yeah, so then eventually the rates will just keep going up. So if the pool gets to a state where it, for instance, is just not being utilized at all, it's extremely low utilization, you can reset the pool back to the original rate. But if it's just not, if there's no lending, if not, there's no meaningful borrowing happening.
Yeah.
How do you guys protect yourself against like MEV and the idea of perfect transparency in networks? Like for example, like Nathan issues bonds, I buy them, they're going bankrupt, I see you coming into an oracle, so I go to Anya and I use them as collateral and dump the ball and then process the bankruptcy on the oracle. Like, do you take steps to protect yourself against that, or like how do you think through those issues?
I mean, MEV is a big problem for sure. There's a lot of very smart technical researchers working on it and making some progress there. I think in the context of securities transactions or, the sort of idealized public blockchain that might, support them, I think it should just be made kind of illegal. I mean, it's like front-running securities transactions. So, I tend to think solutions will just look like, validators being broker-dealers and being, sort of monitored for, not engaging in MEV, but, we're certainly not there yet with any sort of solution. So, for now, it's just kind of a cost that users have to bear.
Maybe building on that, a lot of it's definitely a hot topic these days, but a lot of the work on MEV is sort of quite generic at the level of we have arbitrary transactions and you can reorder them and there's value there. I wonder what the view is on the panel, if that's the right way to think about MEV or if it's a more protocol-specific issue, like maybe MEV for a lending protocol is different than MEV for a DEX and needs to be addressed at that level.
Yeah, I mean, I guess having come from a TradFi background, I see MEV as very analogous to HFT to some degree. There's an aspect to both, at least. There's an analogy between both, which is really an arms race that at the end of the day doesn't really yield any external value creation, but incentivizes various people, actors within the space, to kind of have a race to the bottom in terms of trying to exploit that. My guess is that on the whole, it's it's a kind of a nuisance problem. And I think there are things you can do when you consider a contract that will try to minimize the vulnerability of the contract to reordering interactions within a block. But it's not necessarily a unprecedented problem or a dire problem from the point of view of operating a DeFi protocol.
Yes.
My question is for Nathan and Andrea. This is a curiosity. You have a protocol that will determine the interest rate or whatever you're offering. And it seems that there is an impedance mismatch between your protocol and the real life. In real life, life is steady, but all of a sudden a storm may come up, a black swan event may come up. How would your protocol approximate the real world and handle these extraordinary events that we know that they do occur?
Was that a question for Nathan or?
Either one or any of the panelists.
Well, for the protocols that does have some interaction with real world asset, you can imagine there's force of arbitrage that is equilibrating the yield on-chain versus off-chain yield. That's one way of bringing real world risk premium into on-chain premium, if that's what you're thinking about.
Are you thinking about like what the transition point looks like? That something happened in the real world, and then how does it get reflected on chain? Is that?
Exactly. Actually, on chain, you have perhaps a very well-defined protocol, and you can say that it is a closed system, but it is not totally closed, and it has to interact with the real world.
Yes. So I guess one example of this is the trading of foreign exchange on blockchain, which now you have markets that have developed by itself because now you have stable coins in different currencies. And naturally, there's a formation of markets for trading FX among these stable coins, some of which are on Uniswap, others on Curve. And there, the real world events does affect the exchange rate 24/7 in large part because there is an incentive to arbitrage any difference in the on-chain exchange rate versus off-chain exchange rate. So I think arbitrage is a large factor, but that's just like any other. In traditional finance, you also have different prices on different exchanges, different venues, and there's arbitrage as well. I don't think it's that different.
Yeah, I'll add that there was a recent USDC DPEG, and what you found is that in Uniswap pools, people were competing with higher and higher gas to bring it back to the equilibrium price, right? And so like there was a real world event, people suddenly valued it much lower, but in the process, like to reflect that online, there's just a race of a bunch of people that are fighting to say, well, I will collect it, and you can see the auctions happening. Right, and so I would imagine that even in the other markets, sort of there's like a different race that happens, which is like everybody can see the difference, and you're just, can I fight for it? How much am I willing to pay for it? Right, and whoever completes that transaction kind of gets you over the transition point.
Yeah, Brett.
I wanted to ask you, just brought up the USDC DPEG, and so I guess this is for Gordon about. I was very surprised to see, so when Silvergate and SVB collapsed, there was a USDC DPEG. And that seemed very strange to me because of the dynamics of USDC. There can't be the same kind of bank run from USDC because normal, like average USDC holders cannot withdraw, right? Like if I hold USDC, since I'm not registered with Circle directly, I can't withdraw from Circle. And I was just looking at the top 8 holders of USDC on Ethereum are all contracts that have no ability to participate in a bank run directly. They're like multiple steps away, right? Like Maker can't go to Circle and try to withdraw. And so how can there still be like these bank run dynamics when most USDC holders are actually not allowed to withdraw?
That's a great question. So first of all, what happened during that weekend is a very illiquid secondary market. On average, 95% of volume are direct redemption, direct issuance, direct redemption with Circle, and that's the bulk of the volume. And that's have always been held at 1-to-1. Now, on the weekend, the banking rails are shut down, irrespective of SVB, just because you can't wire people money. It's harder for the secondary market prices to be essentially in line with the primary market price. Now, secondary market price, it's relatively illiquid, it's relatively low volume, so when there are demands on the weekend, that could happen. So in some ways, it's not surprising when you have illiquid markets that price could deviate. But when I think of bank run, I actually think of direct redemption. And I think on Monday, when the market opened again, then forced arbitrage did bring back secondary market price to be in line with the primary market parity price.
So the direct redemption is actually much bigger than the secondary markets being
Yes.
run in general?
In general, yes. There's a lot of market makers that's actually kind of arbitraging between secondary market and primary market.
Yeah.
So maybe I can ask you a bigger picture question. So fundamentally, all finance is useless. Right? It only derives its value from supporting an economy. And otherwise, it wouldn't exist, right? So otherwise, it wouldn't be existing, right? So now, if you look at DeFi seems to be supporting the DeFi ecosystem. There's very little, I would say, real economic activity behind it at this point. I mean, this is fine, right? And obviously, Nathan, you're trying to bring real assets in. I'd like to know from you, what would it take for DeFi actually and blockchain as a whole to actually take off? It was the obvious application to have DeFi applications on a blockchain. But there has to be something more to actually make this work and make this actually valuable. So is this a regulatory question? Is this a complacency issue, or is this a lack of a digital economy that you can actually support? So,
I think this is a catch-22 type of issue, right? It is related to regulatory ambiguity because, if you could actually trade real-world assets as tokenized, you could actually have markets that's developed for the real economy. I mentioned FX as one example in which is starting to develop. What Nate is doing with treasuries is naturally there's a huge need to improve the treasury plumbing system, also the repo market, which always have these bouts of volatility. So there are real world problems to be solved. But until we have clarity, even as simple as a stablecoin bill to be passed, as well as in the future, maybe clarity around tokenization of securities, it's hard to actually implement everything that's been built up almost as if it is in the sandbox to apply to the broader set of financial products, simply because you can't easily tokenize real-world assets and trade it freely.
Can I have a follow-up on that one then? So we have Mika in the UK, in Europe, right? So they obviously have passed, it's passed, and they have a asset-linked crypto asset bill or component in it. So if it's, say, you can find a way how you can register and tokenize assets in Europe, does that have implications on the US? Will the US somehow accept this, or is the US the big obstacle on this topic?
Well, the US is behind in its regulatory approach relative to Europe, relative to Asia. And I think, in some sense, this is about US has always been the center of capitalism, the center of innovation in finance, the center of dollar-based finance and dollar as a reserve currency. Being behind on on the regulatory front could potentially pose quite a bit of threat to the US dominance in capital markets and also in things like payments and invoicing, which could lead to reserve currency.
Yeah.
I have a quick question maybe for you, Matt, but open to everyone else. I'm an MBA student at Columbia, and this last semester I took a class on crypto and blockchain, and one of the speakers who came was a person who is actually a crypto skeptic, which led to a pretty interesting conversation. And something she wrote is that, in traditional finance, we have this idea of mutability. Things can be edited, can be changed. But in decentralized finance, that idea is not that clear. And maybe something, if I misunderstood that, Matt, is that whenever you write a contract, right, a smart contract at Action Labs, there are no governance tokens, and you guys cannot edit that contract as well, right? And what she said is that people actually like that. People in general prefer to be able to edit things in traditional finance. So how did you guys approach that, and why did you decide to take that that decision, that step?
Yeah, I think it's a great question. So, and it gets back to something that I alluded to a little bit in the introduction around QA and the legal system and how traditional contracts are vetted and evaluated. I think if you look at almost any real world contract, you'll see a lot of the word reasonable or reasonable man, or, and there's a reliance that ultimately, if you really need to go to defend your interests in a particular contract, the legal system will operate and judges will make reasonable determinations. Perhaps the jury will make a reasonable determination in favor of your interests because you're being reasonable in your interpretation of the contract. I think for many purposes, that is the way to operate and will continue to be the way to operate. However, it's obviously a very expensive and inconvenient process to have to resort to the legal system continuously to enforce what seems to be a pretty straightforward rule, right? So, I really think it's on an extreme. It's on a spectrum of you want some amount of mutability. You want some ability for humans to come in and interpret whether or not who's being reasonable, who's adjudicating the correct side of a particular dispute for many purposes. However, for some things, you would really want something that's ultimately crystalline and very predictable and efficiently implementable without having to actually make recourse to the legal system. So I don't think they're really mutually exclusive. I think there's a rule for both of them. Ethereum and programmable smart contracts really enables this new capability of having things essentially automatically execute without relying on any centralized authority to make a determination on how they should execute.
May I comment on that?
Sure.
Actually, you can make the analogy with an accounting transaction. Consider a smart contract as an accounting transaction. Once it is executed, it's undoable. So parties in the smart contract agrees they will add another compensating smart contract. If not, they will go to the legal system to dispute or adjudicate their claims.
Right. No, and my question was more regarding not only the next steps of creating a smart contract, but it's actually the fact that you cannot edit it. Like, I know you guys run like multiple scenarios to make sure that contract is almost perfect, but what if it's not designed that way?
Yeah, and Q&A has been a huge, I would say, 80% of our activity has been around testing, and not actually the original part of development. One of the things I think has been very useful is the ability to run randomized scenarios with actors through these contracts with thousands of interactions and look at, there's some weird case where the number's round in an inconvenient way, in chess. There's actually different types of invariants that we can evaluate. One is whether a particular something just a very simple technology invariant, does a particular counter match the global value that it should match at all times. That's kind of a simple technology invariant. A much more interesting invariant that's really an economic invariant is, do the value that a particular lender has locked in the contract change with respect to only respect to interest rates and not other interactions that are potentially very complicated that actors have with the contract. Like to me, that is a really interesting new kind of economic invariant we can evaluate in our testing protocol.
And if I could add, I think there is some element of, fully decentralization might not work in certain circumstances. As you mentioned, there are outlier cases in which you need renegotiation of contracts. Before I was in DeFi and before I was in central banking, I used to be a equity fixed income and also equity derivative trader. And there we wrote a lot of dumb contracts. What are dumb contracts? A variance swap that's fixed, that's determined with determined payoff based on a number of fixings. And every time we come to settlement at the end of a year, there's always some days where the stock ticker, for whatever reason, the market was closed that day. The weirdest ones were like, oh, there was a flood of a coal mine in China, therefore we had to throw out that date. There's a lot of renegotiation in finance, in especially large value transactions. There's incredible amount of renegotiation that happens all the time, which I think this is why there are experiments in which settlement finality is a dual-edged sword. Right? There are experimentations on recoverability, for instance, revertibility of transactions, and of course, I think the role of centralized intermediaries will remain as a source that could adjudicate certain circumstances and make the reverse payment if necessary. So perhaps that's a broader thought on how decentralized it could be.
Achilles, you had a question?
It's a question for Nathan. I'm just trying to understand, what is really the sort of objective behind Ondo? Are you trying to sort of force or catalyze the US government to make the treasury market better? The reason I ask is, or is it something else? Because, I mean, at the end of the day, right now, is it better to own a bond through a token, or is it better to own a bond through some generic broker, right? And so I'm just trying to understand how you're approaching this.
Yeah, it's a great question. I mean, I think the reason to tokenize any sort of real world asset is to be able to use it in on-chain financial infrastructure. So as an example, to be able to post it as collateral at a lending protocol that is autonomous, is global, is 24/7, is not run by a central intermediary. That's not something that you can do with a traditional bond in your brokerage account. So certainly if you're looking to just buy a bond and hold it for some amount of time and then redeem it or sell it, there's really no point, certainly today, in doing that on chain. And I think the security token space is a little bit tainted in that historically it has been this kind of innovation theater. Like all these security tokens have been issued, investors take delivery of them on chain, they just hold them for some amount of time and then they expire. And I think it's sort of a necessary stepping stone to show that it can be done in a legal and compliant manner, and to educate folks at these institutions about what is possible in the future in terms of using them in on-chain financial infrastructure. But we're only just starting to get to the point of demonstrating any of that, in part because we didn't have any of this on-chain financial infrastructure until really a couple of years ago with what was developed in DeFi. So yeah, I mean, for us, treasuries are just it's sort of a natural early use case, but we're very asset agnostic. But yeah, I mean, I think it's a good beachhead for us, just given how much capital is on chain and the friction between on and off ramping from stablecoins for treasuries.
So I think that's about the end of the time we have. I want to make one quick announcement, which is when you come back tomorrow, make sure to check in at the front desk. Even though you may have a badge and forth, please check in so that we can follow up with people and do the surveys and so on. But with that, please join me in thanking all of our panelists for